2024 is coming to a close, and what a year has been in the stock market. As of this recording, the S&P 500 is up an amazing 28.9%. In 2023, the stock market was up 24.2%. So we're about to close out even better than last year. We have been on quite the bull run the last 2 years. And honestly, I don't see any real signs of it slowing down soon. That said, I'm not in the business of projecting the overall market direction. I believe much of what exists in financial and social media regarding market signals is mostly noise. And outside an unpredictable black swan event, I cannot see a compelling reason why the markets will weaken. However, what I do want to reveal today is a short list of businesses poised to perform big in 2025. Welcome to the Quality Investor. The three businesses we are about to discuss today could be viewed as sexy picks. This is because of the industries they operate in or the way they engage with their customer base. Two of these businesses like to name drop AI in their earnings calls, and the other considers themselves to be a disruptor. I disagree with this notion that they're sexy though. The main reason I disagree is that their business models are rather boring and quite predictable. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. In 2024, each of these businesses has either a loss year to date or a very modest gain. All of them certainly lag the overall S&P 500 by quite a margin. Yet each of these businesses are very strong fundamentally, have an identifiable competitive advantage, and are poised for stellar long-term growth. And that's what I was looking for when compiling this list. Right now, I believe many businesses are trading at quite a premium. And because of that, I think there isn't a solid margin of safety when making an investment. We need to buy stock when the price is reasonable, not inflated. So let's dive into business number one. If you've watched my channel for any length of time, you'll know one of my favorite industries is the semiconductor industry. And in particular, I think Applied Materials is a winner. Applied Materials faced some headwinds in 2024 due to market fears about possible China sanctions, exclusion from the CHIPS Act funding, and hitting the trough of the semiconductor cycle. This has led to a measly 7.6% return year to date for Applied Materials. Yet despite the industry slowdown, AMAT posted 2.5% revenue growth, increased its dividend by over 24%, and added nearly $2 billion to its cash stash. But it is Applied Materials' importance to the nation's AI boom that makes me believe big things are coming. We all know NVIDIA is at the leading edge when it comes to AI chip technology. However, it is Applied Materials that manufactures the leading edge equipment necessary to make these chips. Applied Materials supplies Taiwan Semiconductor, the foundry NVIDIA uses. But it is Applied Materials' necessity in the supply chain that gives them their competitive advantage. And as these AI chips become commodified, a different discussion altogether, Applied Materials will be supplying the equipment required to manufacture these products. Just take a look at Applied Materials' numbers over the last 10 years. Yes, they did slow down quite a bit in growth over the last fiscal year, like I said, at 2.5%, but they're still growing. Looking at other businesses in the chip sector, many of them saw year-over-year decline in revenue, not to mention earnings and free cash flow. Yet we see steady free cash flow growth, the yellow bar here, for Applied Materials. It was down slightly in 2024, but they're also increasing their CapEx spend, a good sign for what they believe is coming in the future. They're reinvesting in their business. Applied Materials also has a strong share buyback program, and like I said, they increased their dividend by over 24% in fiscal year 2024. If we look at their margins and their return on invested capital, all of this trending in the right direction. Increased gross margin, operating margin up, free cash flow margin up, and return on invested capital and return on capital employed, both above 30%. I believe once the semiconductor market rebounds in 2025, Applied Materials is going to see very strong growth in the next year. And I believe this is a very strong hold long term. Applied Materials is currently at $173.02. They're trading at a 20 PE ratio. And when I take my bear case, base case, and bull case, the valuation average of my discounted cash flow, dividend discount, and exit multiple, I get a buy price without any margin of safety at $246.78. I like them with a 20% margin of safety. And right now, I'm willing to buy Applied Materials while they're still under $200 per share. Even at a 30% margin of safety, they're hovering around that right now. That would be a buy price of $172.75. I think there's a lot of room for growth in this business. And remember, what we're valuing is free cash flow. How much cash a business generates from here to kingdom come. Their trailing 12 free cash flow margin is at 27.5%. And my base case assumes that free cash flow margin stays flat over the next 10 years, coming in at 27.4%. And that gives us a 41% upside. So very conservative growth projections here for an incredibly important business in the semiconductor industry. Adobe. The sentiment around this business has been mostly negative. The prevailing notion, especially after OpenAI previewed AI video technology, was that their product was going to be obsolete, and software as a service was done for. This freaked out the market for the graphics software giant Adobe. I did a video detailing these sentiments a few months ago. Please check out that video below. Market fears about this business have sent Adobe negative year to date, losing 7.3% so far. But as demonstrated in that video, I don't believe software as a service is going anywhere. In fact, I think it will increase. Adobe has an incredible economic moat in the form of switching costs. It takes years to master Adobe's products, and this creates customer lock-in. And Adobe has a subscription-based revenue model. This is quite possibly the best form of revenue because it is recurring and predictable. There is also subscription inertia. Once a user subscribes to something, they're unlikely to unsubscribe. Adobe's retention rate is over 80%. Despite Adobe's market performance in 2024, this business is insanely profitable. Ever since switching to that subscription-based model back around 2013 or 2014, Adobe has done nothing but grow its revenue every single year. And in the last 10 years, they've returned 22.5% annually to investors. On a one-year basis, however, they're down 9%. And like I said, down 7.3% year to date. But the metrics look phenomenal for Adobe. Everything is going in the right direction. They have far more cash than debt. Their earnings are on an upward trajectory, and they're buying back shares. They're also increasing their free cash flow. They're down a little bit on a trailing 12 basis, but that's due to a one-time event that will fall off of the trailing 12 numbers after next quarter. We should see them back into the free cash flow growth trajectory in 2025. Once the market sees Adobe's continued strength in their earnings and free cash flow growth, I see nothing but great performance ahead for Adobe. And did I mention how profitable Adobe is? Their gross margins are close to 90%. Their operating margin is at 36%, and both of these have grown steadily over the last 10 years. Their free cash flow margin is down a little bit, and that's due to that one-time event, like I mentioned. But if you look at their ROIC and their ROCE, their ROIC, return on invested capital, is at an incredible 77%, and their ROCE, return on capital employed, at 33%. Adobe is currently at $552.96. A little over 10 days ago, they were hovering around the $490, $500 mark or so. But they've had a pretty nice run up since then to that $550 price. Despite that, I still think Adobe is in for a big 2025. Their earnings come out December 11th, which is Wednesday. And depending on how that earnings goes, we could see the stock price dip back down below 500, or maybe we're in for another large pop in the price. Either way, I think in 2025, we're going to see more strong growth out of Adobe, which will cause positive market sentiment to push Adobe even higher. So right now, I do think Adobe's a little undervalued. This is also a business that tends to trade at a premium. I view them similar to Costco in that way, where their business model is so strong that investors will pay a bit of a premium. So despite it looking expensive, there's still, in my view, room to grow. Now, if they have a strong outlook as part of their earnings, then of course, that could push Adobe's price target, which is now at about $600, even higher. Full disclosure, I have long positions in both Applied Materials and Adobe. I have strong conviction in those businesses, yet this third one, I do not have any position. In fact, I've been wary of the business due to cities enacting laws disadvantageous to this business, as well as consumer griping around fees. But the more I research this business, the more I'm intrigued. And I believe they are poised for a big 2025. This business is Airbnb, the disruptor on my list. Airbnb is actually pretty simple. They are a broker. They match real estate owners called hosts with travelers called guests. A brokerage business model is simple. They just collect fees. Just like Visa, when a user accesses their network, they collect a fee. Airbnb is building a strong economic moat. It is based on the network effect. Essentially, as the host and guest user base increases, the value of the business increases. Airbnb's original premise was providing an alternative to hotel stays. Instead of traditional hotel stays in large buildings, they opened up a world of private residences to travelers. This has led to an arms race of hosts scrambling to provide ever more unique and offbeat types of stays. On top of this, Airbnb began offering experiences. Things like culinary tours, various classes, and much more. This is the network effect in action. The more hosts that joined, the supply side, it created more value for guests, the demand side. Guests then started demanding more unique experiences, and more hosts were happy to supply them. This is a self-reinforcing network. It also has the benefit of a rating system. Guests can rate hosts and vice versa. This creates trust in guests booking stays and keeps hosts accountable for their offering of good experiences. Airbnb is still in its growth stages. Year to date, Airbnb is up less than 1%. However, trailing 12 revenue is up 13%. They are free cash flow positive, which is growing, and they are creating a loyal user base, both host and guest, which creates a strong brand. Airbnb also created a new cottage industry in the world of real estate investing as well, the Airbnb investor. I will do a more in-depth Airbnb video soon, but the numbers and economics look very enticing for this business. You can see Airbnb went public only recently. Their IPO was at the end of 2020, yet we do have data going back to fiscal 2017. And you can see that revenue has just steadily increased year over year, with the exception of the COVID year. But more importantly, they're cash flow positive and growing that free cash flow. They also have far more cash than they do total debt. This is a very fundamentally sound business. But I want to get straight into the valuation. I want to start out with what I think their revenue segment growth is going to be over the next 10 years. Airbnb's revenue growth is driven by two different things. How many nights and experiences people book, total nights and experiences, seen here, and the average booking value of those nights and experiences. So they want to grow the total number of nights and experiences people are booking and increase the amount people are spending on those nights and experiences. Over the last 5 years, they've grown their nights and experiences by 12% annually. And the average booking of those nights and experiences has gone up nearly 7% annually in the last 5 years. So the number of nights and experiences multiplied by the average booking value gives you the gross booking value, and that has grown annually by 20% the last 5 years. Now, after all that's said and done, Airbnb collects a fee on the gross booking value. That fee has averaged just over 13% in the last 5 years. In fact, my year one estimate on the Airbnb fee is at 13.5%. So with that explainer on how the revenue growth is driven for Airbnb, I have a year one estimate for nights and experiences at $490 million. The average booking value is at about $166, and that gross booking value then is at $81.4 billion. With that 13.5% Airbnb fee that they collect, that would give Airbnb's year one estimated revenue at about $11 billion. Over the next 10 years, on my base case, I have their nights and experiences growing at 8% and the average booking value growing at about 1.3%. The Airbnb fee, I have that growing at just under 1% over the next 10 years. That gives us total revenue growth on a base case for Airbnb at 10.5%. That is less than half of what their last 5-year revenue growth was. So I'm being very conservative in my estimates for Airbnb's revenue growth over the next 10 years. On a bull case, I have that revenue growing at 12.5%. I'm estimating 25% of my operating margin in year one, and income tax at just under 20%. And out of every dollar of net income, Airbnb turns that into $1.88 worth of free cash flow. Over the next 10 years, my bear case free cash flow conversion is $1.60, my base case $1.70, and $1.80 for my bull case. I also have the operating margin up to about 27% on the base case, 28% on the bull, and 26% on the bear case. But like I've mentioned many times, what we're valuing is the free cash flow. How much cash is spun off by the business. On a trailing 12 basis, Adobe's free cash flow margin was at just under 38%. My base case numbers for the free cash flow margin based on that 10.5% revenue growth and a 27% operating margin with a $1.70 free cash flow conversion, that free cash flow margin comes out to 37%. I am projecting flat free cash flow margin growth over the next 10 years on a base case. The bull case projecting up to 41.3% on that free cash flow margin, and actually projecting a decline in free cash flow margin to 33% on my bear case. Airbnb is trading at $136.92. Given those projections I just talked about, I have a discounted cash flow price on a bear case at $181.31, base case $229.03, and a bull case of $290.64. The exit multiple is at $107.54. My comps are Booking.com, Expedia, and TripAdvisor. And that's an average PE between those three businesses of 37.7. The exit multiple of $107.54 actually brings down the total valuation average, which is $155.49 in the bear case, $186.51 on the base case, and $226.56 on the bull case. So even the bear case, we're looking at 13.5% upside here. And on a bull case, all the way up to 65.5% upside. Given Airbnb's strong economic moat, the economics of their business, and these very conservative growth rates I have, this is a very undervalued business. Without any margin of safety, that's a buy price of $188.77, a forward PE of 54.8. With a 20% margin of safety, we're looking at $151.01 with a forward PE of 43.8. Right now, they're hovering around the 30% margin of safety zone, which would be $132.14, or a forward PE of 38.3. The ROIC has climbed to almost 18%, above that 15% threshold that we like to see, far above their 5 and 10-year averages. But keep in mind, this is a growth business. They're in their growth stages, and that ROIC is only going to increase as the business continues to scale. They have excellent gross margin. Their operating margin at 15% in the trailing 12 basis is down a little bit due to some one-off tax issues. But like I pointed out before, they have an incredibly good free cash flow margin. And given that they're pretty much flat year to date from a stock price performance in 2024, I think once that free cash flow continues to grow and that margin looks a lot better to investors, once that one-time tax issue rolls off, they're poised for a big 2025. So, Applied Materials, Adobe, and Airbnb are my 3 businesses poised for big returns in 2025. I'm looking forward to checking back in on how they performed midway through 2025 to see how accurate my prediction turns out to be. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.